So you guys wanted a trade breakdown of this trade that I just took. So I thought maybe why not? I should just give you a breakdown of it and explain my thought process behind this trade and why I took this entry and what was the reason behind my stop loss entries and targets. So now we're going to start off with the daily time frame. Now let me remove all of this and we're going to start all over again. Now if you've observed the higher time frame, then you might know that this high right here is a weekly CRT high. Now it's also in the form of a daily range high, but more importantly it's a weekly CRT high, which means it's a stronger key level that we can react off of. Now what happened 2 weeks ago is that we were approaching this weekly CRT high. That was our drawn liquidity, and then on the 15th of May we took out that weekly CRT high with this big bulky candle. Now if you watched my video on how to select CRT correctly, it's on YouTube, then there was this protocol, actually the first protocol, which was a lower time frame in the CRT within a higher time frame CRT, right? And this CRT right here, this big bulky candle right here, follows exactly that protocol. It's a live example of it, right? So with this big bulky candle we took out that weekly CRT high, right? And then this CRT became our lower time frame CRT on the daily. Now according to that protocol, we know that after such a phenomena happens, we're going to then wait for one side of that CRT to be purged on the lower time frame, and then our drawn liquidity are going to be the 50% of that CRT range and the opposing end of the range, right? So when the next weekly candle opened right here, right, on the 20th of May, what happened is on Monday we took out this Friday's high and formed the high of the week, and then the rest of the week we expanded lower to take our drawn liquidity, which was in the form of this daily CRT low. Then we took out this CRT low on Thursday, and then we had a classic TGIF, and we reversed from there. Now when this new weekly candle that we are currently dealing with opened right here, we had this typical Monday range, right? So it was a ranging candle, and then what happened on Friday, let me show you, as that we took out this Monday high, so that became our daily CRT that we could work with, right? So that is our daily CRT high and that is our daily CRT low. But not only that happened, what happened is that we also tested this rejection block right here, right? We tested this rejection block, and not only that, we also had a SMT divergence with pound. Now if you watched my video then and if you read my tweets, then you would know that the two key factors that lead to an expansion are a failure swing and a SMT divergence. And now in that case we had the same thing. So what happened is that you can see right here, this high right here on Tuesday, we came above this daily CRT high right here and form a failure swing. We did not take this high because it was a protected high, but what we did is form this failure swing right here, and also we had a SMT divergence with pound dollar. Right now let's get back into the breakdown. Now so when this new Wednesday candle opened right here, what I was expecting is a bearish candle, an expansion, a candle that expands lower, right? And my drawn liquidity was at first this daily CRT low right here. Now you might be wondering that the trade that I had posted was a long trade. It wasn't a short. But let me tell you, the reason for that is actually pretty simple, and it's a logical one. Now if you know how the market was, and if you have watched Romeo's video and know about market profiles, then you would know that the market never moves straight up, straight down, or straight up. The market never moves in this fashion, right? The way how the market actually moves is it forms a range. It forms a range, and then after a range it has an expansion, and then once that expansion happens, we don't have another expansion. The most probably then now what happens is that after an expansion occurs, we either have a retracement. So we either have a retracement, right, or a complete reversal. In this case, we either have a retracement and then expansion, we either have a complete reversal, or we form another range and then wait to see whether where the drawn liquidity is. So if the drawn liquidity is higher right here, then we're going to wait for a range and then look for that range low to be taken or that CRT low to be taken, and then for price to rally higher. But we can also have another scenarios, and let me show you how. Now let's just say this expansion has occurred. We can also have what? We can also have a retracement, and retracement to where? To the origin of here, and then an expansion higher from here. So now what you can do as a trader is that you can either profit off of this expansion leg right here, right? The second thing that you can do is that you can exploit this counter move right here. So even though our drawn liquidity is higher, or maybe in other cases lower, but we still can take counter trend shorts right here. But that's only for advanced trader. If you are a beginner trader or intermediate trader, then you must only take trades towards the drawn liquidity, and you shouldn't be taking counter trades because that requires a bit more intuition and experience. But my point with this video is, and this breakdown is that you should understand market profiles and how market actually works. Now the same thing happens with a daily candle, a 4-hour candle, even a 1 second candle or 1 minute candle. Let's just say the price is determined, our drawn liquidity is here. Now let's say we are dealing with a 1 hour candle, for instance, right? So price never does this, right? It never does this. If price is determined to go higher towards that drawn liquidity, what happens is that price opens right here, we form a range, then we have a manipulation of that range, then we have an expansion. Now after this expansion happens, we then either enter as a reversal profile if the drawn liquidity has been met, but in this case the drawn liquidity hasn't been met. So we can have two outcomes. We can either have a range and then a continuation from here, right? Or we can either have a reverse or a retracement in the form of a OTE. If you've read Romeo Street and if you are familiar with Romeo, which I know most of you are probably familiar with him. So this is what we call an OTA. And then price expands higher, right? This is basically dynamics behind every single candle, every single asset and every single time frame. It doesn't matter. It could be a 1 hour time frame, it could be a 4 hour time frame, it could be the daily, weekly, monthly, it doesn't matter. Price always moves like that. What never happens is the price, let's say we have this expansion, what never happens is price never goes like this, right? It never. This is what we call market profile. So when you are stuck in this range and you don't know, let's say you've already missed this move right here, right? And you still know that the drawn liquidity is higher and want to profit off of it, then what you can do is they either wait for a range to form and then take a long from there, or you can take a counter trend short is an OTE and then wait for an expansion here, then wait for a price to form support here, either in the form of an order block or whatever, right? You can match it with any PDRA, and then from here you can expect an expansion. Now if you are an advanced trader, you have three opportunities to milk the markets or to exploit the price movements. You can exploit this expansion, you could exploit this counter trend expansion in the form of a OTE, and then you can take profit off of this expansion. Now this is, as I said, the open high low close concept or market profiles basically. Now let's get back into the our example. Now on the daily here we're going to go down to the 4 hour now. Now on the 4 hour, as I said, this was the CRT low right here, right? And that is the CRT high. And on Tuesday we took that CRT high, we tested that rejection block, we had the SMT, everything was in place, right? And then Wednesday candle opened here. So now when we were right here and we still hadn't taken this CRT low right here, I was expecting this CRT low to be taken. That was our drawn liquidity, and that hadn't happened till London Open. So even during London Open, my drawn liquidity was lower, and I was looking for this CRT high. And the reason why I've chosen that particular CRT high is because of the timing of the CRT. It forms on 9 p.m., which perfectly aligns with the Asian range. Now if we go down to the 5-minute time frame, where is the 5? Okay, here it is. So if you go down to the 5-minute time frame, what you're going to notice is that if you have watched my video on my favorite model, which is the 3M model, then you would know that I wait for the 9 p.m. CRT high or low to be taken during a specific time window, and that time window is between 3 a.m. to 4 a.m. And if you look right here, then you would see that this purge happened exactly at that particular time window. And then after this happens, you're going to wait for a CSD to occur, or which means you're going to wait for the price to close below the candle that dug above the high, which was this candle right here, and then price close below here, and then you could have taken your entry right here as a short with your stop loss above this swing high, and your target would have been that daily CRT low. But that is another trade, a trade that I actually drew, and the thought process behind that trade is, let me explain it to you. Now we're going to go to the 15-minute time frame. Now all of these things that I'm saying are based on proper logic and proper framework. Now if you have an average IQ, or you're someone that is an average, as an average intelligence, then you would notice that I'm actually speaking in a logical manner. I'm not pattern trading. I'm not looking for random bullshit FVGs or order blocks. Everything that I'm choosing, every PDRA, every single time or time zone that I'm choosing is based on a proper logic, right? I'm not just choosing random patterns. So on the 15-minute, let's see. Okay, so we're going to remove this right here. Now this let me do this right here. Wait, I'm going to turn off this magnet right here, right? Okay, so this right here as Tuesday, where we took out the daily CRT high and had all of that price action, right? Now as I said, even though on Wednesday I was expecting bearish price action, right? And on during London kill zone, we had that bearish price action right here in the form of this. So you can see what happened is that we had this range right here, right? Then we had this expansion right here. And remember what I told you before. I told you that after an expansion, if you want to exploit the move and if your drawn liquidity is still lower, then what you can do is either wait for a range, or you could take a counter trend long from here. So I know that even if price has to expand from here, it's not going to do this. Such price action never happens. Like maybe rarely, like 5 to 10% of the time, but statistically speaking, most of the time, 80 to 90% of the time, what is going to happen is we're going to have a retracement and then an expansion. And this is exactly what happened. You should carefully notice every word that I say and every single concept that I explain. Now based off of that logic, we're going to the 1 hour time frame, right? But you're not going to take a counter long just out of nowhere, right? You have to wait for the right times. You have to couple it with a CRT. If there's no CRT, and if you cannot match it in conjunction with any significant concept like CRT, then you should just forget about it. you shouldn't be taking that counter. The reason why I took this trade right here and took that counter is because I knew what I was going to do, and I could couple it with a CRT. Now what we've got here is this rejection block right here, and also around this rejection block we have this CRT, we have this CRT low and this CRT high. And also at this time the London kill zone has started. Not the London, actually the New York kill zone had started, and the New York kill zone is from 7 a.m. to 10 a.m. and that basically is a micro for price to either retrace or reverse based off of Asian range and London opens price action, right? So as I said before, we had an expansion. Now we can expect a retracement even though around liquidity is lower, right? But I coupled it with this CRT right here, and I knew that before price could expand lower, we have to and we had to take this CRT high right here, and then price is gonna expand lower. So now I waited for this 1 hour CRT low to be taken at the right time, meaning either the New York zone or from 8 to 10 a.m. It happened at 7 a.m., which is also a good micro because it perfectly aligned, everything perfectly aligned. So it was good enough for me, right? And then what happened is that I went down lower to the 5-minute time frame. So it is all based off of time alignment and time frame alignment. So if you're using 1 hour CRT, then you could either use the 5-minute or the 3-minute for your entries, right? So now again we go back to Romeo. Romeo has provided you everything. I'm just acting as a Romeo Bible for you, right? I'm giving you everything that Romeo has already explained, but I'm explaining it in a way which might resemble with you or which might be familiar with you, right? I'm explaining it as in the most simplest way possible. Now, one of Romeo's favorite model and one of Romeo's easiest model that I still trade to this day, all of my entries are based on this model, are this. So we have a range low or a CRT low or a range or CRT high. So now we've got these key levels. Now what happens is that we're going to wait for this key level to be taken, and once that key level is taken, we're going to wait for a CSD, and CSD basically happens when we closed above this high right here, and then we're going to have an order block here. What we're going to do is take an entry at the open of that order block. Our stop loss is going to be below the swing low, or we're going to target 50% of the range and the opposing of the range, and we're going to ride it here. So this is basically the model in one entry, if you didn't know. So I waited for the CRT low, which is this, to be purged at the right time, which happened at the 7 to 7:20 am. It's a good macro. And then I waited for a CSD, and a CSD happened right here. You can see that price closed above the low, the candle that dug below the low. Now you should note this sentence: a CSD happens when price or an order block forms when price closes above the high, closes above the candle that dug below the low, or in case of a bearish order block, and a bearish order block forms when price closes below the candle that dug above the high. Now based off of this logic, we had this order block right here, and then I took my entry right here at the open of this order block, and my stop loss was right around here below this order block low, and my first target was 50% of the range, which is I think somewhere right here, and then I target the opposing end of the range, which is this. Now you can see it offered me around 6.5 hour. That is a lot. So now, considering this in mind, even if I lose the next 3 to 4 trade, which is not gonna happen, because the win rate that I have with CRT and the logic that I use, statistically it is possible, but really rarely I have like losing streaks of 4 to 5, right? I try to maintain my losses and keep them like contracted, right? You know what I mean? and then if you have a partial system, then your win rate is going to increase by a huge margin. Because if you're going to take partials and always move your stop loss to break even at the right time, then you're not going to lose in a trade, because you've already taken out some profits. That's the importance of a partial system, right? So now, let's say based on risk management, even if I lose the next 3 to 4 trades, I'm still going to be in profit, in 3 hour profit, because this trade alone offered me 6 hour.